Okay. Hello, everyone. Welcome all. I welcome you all to our Quant PMS webinar. We haven't been doing this very regularly, but since there have been so many queries regarding our Quant PMS, we thought we'll do it, and from now on, maybe we do it much more regularly as well. So I welcome you all. If you have any questions, I'll just take you through our Quant PMS, these two PMS, and if you have any questions, you can just put it out there in the chat as well, and I'll be happy to take your questions towards the end. Right? Okay. So yeah. Now, quickly about our company, Estee. Now, Estee is a pioneer in systematic investment in India. It started its operations in 2008, and our vision is purely data-driven investments and trading. That's what we have been doing since 2008. So it's been almost 16 years now. Now, quant has been a buzzword in the last couple of maybe years, but we have been doing quant for 15, 16 years now, right? We operate in almost 6 countries. We are managing retail institutional money of over 1,500 crores. And we have also been awarded NSE Institutional Member of the Year in 2019. Our PMS, we have been running our PMS since 2009. One of our PMS, a very successful PMS, which has a unique track record of never losing money on a monthly basis. And more recently, about 5 years back, we also started Long Alpha PMS, which is into equity space, right? Quickly about our founder, Sandeep Tyagi. Uh, he is an alumni of IIT Delhi and he did his MBA from Columbia Business School. And he has 30 plus years of experience in portfolio management, analytics, and consulting. And I am Vivek. I am the head of investments at Estee and Gullak. I'm a BTech and MTech from IIT Kharagpur, and I have 20 plus years in trading and investment management. So these are the products that we currently offer at Estee. On the retail side, we have Gullak small case portfolios. Many of you might have already subscribed to these portfolios. And on the PMS side, which is where the threshold is 50 lakhs of investments, there we have two products, Long Alpha, which is equity based product, and I Alpha, which is an arbitrage strategy. And I'll take you through both of these products going ahead. So Long Alpha. Now, Long Alpha, as I told you, it's an equity-based product. In this, what we do is out of a overall universe of BSE 500 stocks, we select stocks about 100 or so, and then we construct portfolios. These are purely quantitative portfolios, data-driven approach is used. And I'll talk about how about the specific methodology we are using and why we are so successful. So what we are using in this is, which is popularly known as factor in. Now, what happens in factors is factors, they are systematic factors which are thought to be the driver of returns. The key driver of a specific stock or sectoral returns, those are known as factors. Now, these four mentioned here are the most popular four factors, and obviously there are many, many more. So I'll quickly take you through these four factors. What are they and how we exactly use them? So momentum is the most popular factor here. And in momentum, what we do it is uh, it reflects the historical returns with strong performance. That's what we try to do. And how we select it, we can actually select it using past 3 months returns, past 6 months returns. So let's say we sort all the BSE 500 stocks in decreasing order of their returns in these past 6 months. And then we select the stocks which have given the most returns. And the idea behind that is the stocks which have given very good returns in past 6 months would continue to give good returns in the near future as well. That's the idea behind momentum. It works really well, and I'll share the data related to that. Value, again, a very popular factor. A lot of fund managers use it. And what they try to do is stocks that are undervalued. That's what they try to pick. And how do you judge whether a stock is undervalued? There is no one specific method, but based on their PE ratios, their price to book ratios, how they are growing in sales, earnings, net profit. There are multiple fundamental factors that you study, and then you determine whether a specific stock is undervalued or not, and then you make a portfolio of those undervalued stocks. Okay. Next is low volatility. Again, what happens in this case is stocks where prices are relatively lower volatile, they are picked. And historically, what has shown surprisingly is if you pick stocks which are relatively lower volatile, then the portfolio tends to give you equally good returns as compared to index, but with much lesser risk, with much lesser drawdowns and much lesser volatility. So what happens is your risk adjusted returns goes up. And how do you pick those stocks? Those stocks could be picked on the basis of, let's say, historical standard deviation. Now, again, what historical time frame we are looking at, it totally depends on how you are modeling these specific factors into the overall portfolio construction approach, right? And finally, the fourth one is quality. This is also quite popular. Many of you would have heard about this specific way of selecting stocks that are that are having very strong, let's say, quality metrics like, let us say, return on equity, higher earning stability, or how strong a company's balance sheet is. So these specific stocks might not be really undervalued. They might be fairly valued, but they are very good quality companies in terms of how you are actually measuring that specific quality. Now, many of these are also used by most of the traditional fund managers also. So in factor investing, in quant investing, we are actually doing nothing new really. We are using similar factors, but only thing is we are able to quantify this specific factors into numbers and then use those numbers to construct our portfolios. Now, what happens again in factor investing is if you look at this specific chart, what is happening here is you see there are a lot of churning going on in terms of which specific factor is performing well. Sometimes it's value, sometimes it's momentum, at other times it's low volatility. So there's a lot of churning, and depending on different market conditions, there is something or the other which is actually working. In this, what we have also added is Nifty. So if you see overall in the last 10 years or so, about 11 years, if you see the last column, Nifty has given about 15% returns, whereas each of these four factors that we have seen has actually given more than Nifty. So quality, low vol, value, and momentum, each one of these have given more than Nifty. And our long alpha PMS has actually given even more than each one of these factors, which is 28%. And I'll get into the reasons why we have been able to do it. Now, as I've told you, these factors are very, very uncorrelated. Sometimes when momentum is working, then value doesn't work. So this specific chart, it's a much longer chart. And here I wanted to show you how these factors are uncorrelated, which means that they don't work together all the time. So if you see in this specific chart here, around 2010 is the time when value worked very well, whereas momentum as a factor lost big time, right? There are other times also where momentum has done well and value has been losing, right? So there's a lot of cyclicity in how they are performing. So you can actually use this fact. That is what we are using in our portfolios to construct our portfolios, which are better than the individual factors, right? So what we are doing is we track almost 130 factors. So I've just told you about these four factors, uh, and uh, we are using more than 130 factors. So these are the four most popular factors. The other factors that we are using are, let's say, how the company's insiders, which is the company's management, buying its own stock. And they have to obviously reveal this information to the exchanges, and we track that information. So that is a one factor. So all things being equal, if a company's management is buying its own stock, that means company's management has a very good confidence on that specific stock, and then that is a positive kind of information for us that we take into account, right? Other factor could be, let's say, index inclusion and exclusion. Now, what are the stocks that could be included in BSC in let's say Nifty 50? So they'll have that positive bias, whereas the stocks that are likely to be excluded from Nifty 50 are going to have those negative bias. So those are the other kind of bias, or let's say buying by mutual funds, or how is the volumes overall in FNO. That gives us very good edge into how the stocks could be performing, right? So we have identified more than 130 factors, and what we are doing is we are taking into account the global macro environment, global and local macro factors, and we are seeing which are the stocks that are likely to work based on the historical data. We have seen which are the factors that are best likely to work in the current market regime, whether it is value or momentum, or whether it is quality or low vol, how they are likely to work best. And then we select those few factors that are likely to work best in current market conditions and use that to construct our portfolios. Now, we have done this historical testing, and obviously now we have the live track record also, but we have done this historical testing going all the way back to 12 years. And this testing we have done not only in India, but multiple other countries like USA, Brazil, Hong Kong, China. So we have tested our systems, and the good thing about a systematic quant-based approach is obviously that the systems don't get greedy or fearful. So it eliminates all the emotional biases that a fund manager might have. Right. Now, this is the performance over last 5 years that this specific current model has been running. And you can see out of those 5 years, 1 year, 2022, where we actually underperformed. And in rest of the years we have given pretty good performance. Now, if you see, uh, I think this is very common with active fund management, that it's very hard to beat the index consistently. So I think that's what our expectations, your expectations should be as investors in this fund, that out of every 5 years, maybe 1 year, there will be case where we'll underperform. But when we do underperform, the expectation should be that the extent of underperformance is not too much. But when we outperform, the extent of outperformance should be really high. And that is one of the ways that we are actually, this is a result of how we are churning our portfolio. So obviously, I think you guys would know that in quant, generally the churn is relatively on the higher side, right? But the advantage is also there. So there is a downside of higher churn, which leads to maybe higher slippage, and these results are obviously after the slippages, but they are very good things also. The good part about high churn is if a stock is not working for us in terms of the returns it's giving, we tend to be very quickly remove it from our portfolio. Whereas if a stock is working, obviously that will be a part of our portfolio for much longer time frame. And due to that higher churn, our risk management is very strong, because we are actually not holding any stock which is not giving us returns or losing money for us. So we tend to really churn those stocks or remove those stocks very frequently. But that actually helps overall in our risk adjusted returns, right? Now, this is a chart where it shows that 50 lakhs invested in Long Alpha versus 50 lakhs invested in BSE 500, how much it will be. And as you can see, we are almost double of what BSE 500 portfolio would have given, right? Right. Talking about risk, I think most of the people do talk about returns, but they forget to talk about risk, especially in the PMS industry, because the general trend or the general myth here is that you need to have very concentrated portfolios. You need to take higher risk if you want to generate higher returns. Now, we do not think so. If you see our portfolio versus BSE 500, so in terms of maximum drawdown, which is actually uh, all throughout the last 5 years or so, what is the maximum BSE 500 has lost, which is about 30%. Whereas if you see our portfolio, our maximum loss has been roughly around 17.7%. So in that sense, we are doing much better than BSE 500. Again, standard deviation, which is again a measure of risk. In that also, if you see BSE 500, which is a portfolio of almost 500 stocks, has risk of about 18.8%, and we have lesser risk than BSE 500. So in terms of these risk parameters also, we are doing very well, and we will be surprised to know, maybe even disappointed, some of you might be, that we have our PMS portfolio is constructed of almost 100 stocks, right? And as I am telling you, because we are taking similar or lower risk, our Sharpe ratio, which is a measure of risk adjusted returns, is almost double or more than double that of BSE 500. So Sharpe ratio is a formula which has risk divided by, sorry, returns divided by risk. So if your risk is higher, then the Sharpe ratio would actually be lower, right? So in terms of the Sharpe ratio, again, Long Alpha has been doing almost double that of BSE 500. Let me quickly look at these questions. Yeah. So there's a question about taxation, and then there's a question about automatic rebalancing. So I'll take, Shriram, I'll take these questions towards the end. Okay. Yeah. So let's move ahead. Now, again, in this slide, what we have shown is the on an annualized basis, what has been the maximum drawdown. So every year, what has been the maximum loss that BSE 500 has seen versus the loss that Long Alpha PMS has seen. Now, if you see in this, uh, I think it's pretty much in line. So first 2 years, we were doing roughly similar to what BSE 500 did. In 2020, the COVID year, that was pretty good year for us in terms of risk. We lost almost 13% versus 29% for BSE 500. So we were able to control risk during the COVID fall, actually. After that 21 year, again, it was good. 22 was the year, I think the only year where we actually lost more than BSE 500. So BSE 500 had a maximum drawdown of 9%, whereas we did 17%. So this was the only year where our risk or our drawdowns were more than BSE 500. And last 2 years, again, 23, 24, again, I think this number 0% is not correct. We have obviously seen some drawdowns, but our drawdown is pretty much for the last 2 years in line with BSE 500. So the point I'm trying to make here is our risk in Long Alpha Quant PMS is similar to that of BSE 500, whereas the returns are almost double, right? Now, what is happening in terms of diversification according to market cap? Now, this specific Long Alpha portfolio is a flexi cap portfolio, and the algorithm figures out where the most opportunities are, and accordingly, it will keep on adjusting the allocation to the specific market cap. So if you see over the last 5, 6 months, in fact, last year, whole of last year, we were very highly allocated to mid and small cap. More than 80-85% was actually allocated to mid and small cap. Whereas now in large cap, we have almost 30%. So over the last few months or so, our large cap allocation has been going up because we see much better opportunities in large cap space as compared to last year. So that's what been happening here. In terms of sectors also, every month, because of the whole new data that is coming in, these sectoral allocations might change, and sometimes it might change just too frequently as well. But as I've explained to you earlier, that helps us overall in producing better risk adjusted returns. So as of now, if you see in May, we are currently bullish on healthcare, consumer discretionary, consumer staples. Now, these two sectors are pretty much in line with BSE 500. And we are underweight on financials. And I think IT is another sector where we are hugely uh, bearish. But otherwise, healthcare, consumer discretionary, and consumer staples are the sectors that are currently we are overweight. But again, this might change. This might change month to month. So Yeah, that's what happens in quant-based portfolios. Right. Now, I'll quickly take you through some of the myths that are prevalent. Okay, Naveenji, I'll definitely answer this question as well. So now I'll talk about the myths of quant investing. Now, one of the popular myths is quant is a black box, right? And it's hard to figure out what is happening inside. Again, as I told you, it's a myth. Quant investment, all the inputs and all the processes that we have, they're very, very transparent. Only thing is they are automated in nature, right? But we can actually minutely see what is happening to each and every stock, why it's getting selected based on all the 130 factors, which specific factor is leading to a stock getting selected or removing. And all the decisions that are being made, they are very, very systematic and being made in a very disciplined approach. And this does not have any bias that a fund manager might have, right? And obviously, we are doing all the continuous monitoring of our portfolio, how each stock is performing, how the overall portfolio and each sector is performing on a daily basis, right? And on a monthly basis. So it's overall just a myth that we don't understand what is going on inside these black box strategies. Now, the second myth that we see is quant investing rely only on technicals and ignore the fundamentals. Now, with most of the players, that is true. So you got to figure out whenever you are judging or analyzing a specific quant strategy, you got to look a bit deeper and see exactly what the fund manager is doing, whether they are using purely technicals, which happens with quite a few quant investing funds, but some of the good ones who have experience and definitely we have been using these multi-factor models, and as I've told you that these are a combination of technicals, fundamentals, as well as macroeconomic factors. So macroeconomic factor could be one of the factor could be, let's say, oil prices. So how does oil prices impact each industry, right? It could be inflation, it could be the interest rate or the GDP growth rates. These are now the macroeconomic factors. Next, we are integrating multiple aspects of both fundamentals and technicals, and which result actually in much more consistent performance of our portfolios, as you have seen in the last few slides, right? And we actually use like all the fundamental fund managers, we are using all the fundamental ratios like cash flows, quarterly results, and their trends, price to equity, price to book. All of these factors are being used in our quant portfolios. So again, this is a myth that we just rely on only on technical factors and we ignore fundamentals, because fundamentals actually now can be quantified very, very easily, right? And the third myth about quant funds are also that they are backward looking. You always look at the historical data, do your back testing, and then you construct your portfolios. Now, obviously, when we started this specific fund in 2018, that's what we all only had. We just had the historical results, but you have already seen what we have been able to produce just by looking at those historical returns, and now we have live track record also. But at the same time, if you look at even discretionary portfolio managers, uh, I don't think they are actually predicting anything in the future. What they are doing is they are also looking at this historical data. Only thing the data that they are looking at is mostly fundamental and qualitative in nature, but they are also using historical data for their portfolio construction, right? And again, as I've told you, because we have had live results also, one of the very key risks in these quant strategies is that while you are doing your back testing, you actually overfit your models. So what overfitting means is you have made your models in such a way that obviously that has worked very well in the past, but it's no guarantee that it will work in the future. So that's a risk that somebody who does not understand how this quant investing and back testing works would make. But as I've told you, we have been doing this quant investing and trading for more than 10 years now, and we we very clearly understand what are the risks uh, and what are the things that one should avoid while creating these models. Okay. And again, there are now prediction techniques with AI and ML models, in which we can forecast market volatility, earnings, or market sentiment. So some of these things are in the experimentation stage also, but then these models can actually help us predict some of these things in the future as well, right? Now I quickly take you through the another product that we have, which is iAlpha. Again, this has been running for about 14 years. It's an arbitrage fund. So what happens in an arbitrage fund is uh, a very simple example of, let's say, Nifty 50, which has 50 stocks, and the weight of these 50 stocks again is different. So what we'll do is we'll keep tracking the stock prices on a millisecond or a nanosecond level. And whenever we see that there is a difference between Nifty and its components, we will take that trade. So let's say Nifty is at 20,000, whereas all its components combined in that specific allocation is trading as at 20,100. So there is a difference of 100 rupees. What we'll do in this specific strategy is we'll buy Nifty and we'll sell all the Nifty 50 stocks in order to capture that 100 rupees. Because at the end of the month, when these futures are expiring, they'll be trading at same price. So in effect, what is happening is you are capturing that 100 rupees sure short profit, which will be realized by the end of the month. That is what arbitrage strategies, in that we are not taking any market risk. So irrespective of whether the market is going up or down, what you are going to get is that 100 rupees, right? This specific strategy, this specific fund, which is again a PMS fund, has a track record of almost 15 years. Annualized returns are currently, historically rather, it has been around 12% annualized, and zero negative months since inception. So if you see these returns, I'm not sure whether you can clearly see them, but if you see since October 2009, we have been running this specific strategy, and every single month has been a profitable month. So it is, you can call it, it's as safe as FD. And the good part about this is, as you compare it to FD, which is, in FD, your money gets locked in for at least 1 year or 2 years, whichever FD you've taken. But in this, your money is not locked in. So it is a monthly liquidity product, which means that if you want money at the end of the month, you just have to inform us 10, 15 days in advance and you'll get the money at the end of the month. Right? So it's a monthly liquidity product. And how this is being used is, it's being used in two ways. One way is, if obviously you want to uh, on some part of money, whether it's in FD or debt funds, you want to take lower risk. This is a very good alternative to that part, alternate to either FDs or debt funds, right? Or another part is, let's say you think that markets are currently overvalued. I'm not comfortable putting full 50 lakhs in equities right now. So what can be done is we can actually use this iAlpha to create a systematic transfer plan, in which what we'll do is, let's say you invest 25 lakhs in Long Alpha, which is equities, and rest 25 lakhs in iAlpha, which is a debt fixed income product. And then you can make a plan, something like, let's say you want to transfer 5 lakhs every month from Long Alpha to iAlpha, so that over the 6 months or so, in equity, which is Long Alpha, you start with 25 lakhs, and over the next 6 months, you end up transferring full 50 lakhs to equity. And obviously, you'll be making some money on this debt allocation during these months as well. So this is a very popular plan which is being used by investors to enter into equity markets. And this could be 6 months, this could be 3 months, or this could even as long as be 12 months. Or if you want to just stick to a 50-50 or whatever proportion you want to invest your money into equity versus debt, you can choose. So it's totally flexible, right? Now I'll take a few of the questions that we regularly get, along with, I think, a few of the people have asked questions. So please put in more questions also. So I'll just quickly take these questions and the questions that you have asked. Okay. So one of the questions that we very frequently get is it the right time to invest in stock markets considering they are near all-time high? So my response to that is, frankly, we do not know. We do not know because we do not know how the markets are going to perform in the short run. Whereas next 3 months or 6 months, we can't predict, and we don't believe that anyone can actually predict the markets in the short run. So if you want to put money into equity markets, have at least 3 to 5 year kind of time frame. The longer it is, the better it is for you, right? So if you have, let's say, a 10-year time frame, then it really does not matter whether you put money right now or maybe 2, 3 months down the line. What will matter is whether you have remained invested for those 10 years or not. That is a much bigger question than right now, should I put it or should I put it over next 3 months or 6 months? Those are not really big questions if you are investing for the long term, right? And secondly, as I've already told you, if you are really not comfortable putting money, you can use iAlpha to systematically transfer money over next, say, 6 months from debt to equity. That is what you can do. Now, next question that we get very commonly is how are you able to provide high returns despite being so diversified? In fact, many of the people actually tell us that they wanted to invest in a very concentrated portfolio because that's how they thought the returns are being the alpha can be produced, and which to an extent is right, because in terms of if you are creating your portfolios that the traditional way, then yes, then it is true that you need a concentrated portfolio because your holding time is also longer. You actually need a concentrated portfolio to generate those higher returns. But as I've showed you, because of our higher churn, that actually helps us in that risk adjusted return. So any stock which is not doing well, we'll cut it. Even though we might take a decision that it's again starts doing well and maybe 2, 3 months down the line, we'll again take exposure. But if it is in that downward trend, if that downward trend has just started, we'll actually be very fast in cutting it because we are churning on a monthly basis. And that's why we are able to provide, even with those 100 stock portfolio, we are able to provide you with very high returns, at least in the past. That's what the trend has shown, right? The last 3, 4 years have been very good for the markets. How do you plan to maintain this performance? Again, investing in equity markets, investing in these active funds, there is no surety that we will be able to provide, right? But I think our methodology is quite strong. We don't want to take excess risk to generate higher returns. That has been working in our favor. And whenever the markets go into bearish phase, I think that is going to help us a lot. Many of these highly concentrated portfolios of PMS lose a lot during those bear markets or even sideways market. But because of these 2 or 3 things, one is we are using multiple factors to create portfolios. Again, those factors also keep on churning, which means that if today momentum is working and tomorrow market starts trending downways, then momentum would lose heavily, and our allocation to momentum would go down, maybe even to zero, and maybe we'll shift all our allocation to value as a factor. So that helps us across market cycles maintain a good level of performance. And having said that, I think even in 4, 5 years, last 4, 5 years, 1 year has been negative for us in terms of excess returns, and this would be the same even for next 5 years. That not all the years would be we would be producing alpha. There will always be some time where we'll actually be losing as well, right? Now, there are funds with even higher returns than yours. Why should I choose LA? Now, first of all, there are not too many funds which are returned higher than ours. But I think why you should choose LA is also because of the risk. So if you look at the returns or risk rather of those funds that have produced higher than us, there's there's a very high chance that they're taking very high risk with the portfolios, which means that when the markets actually starts correcting, there's a good chance they lose much more also. So whenever you're looking at returns or whenever you're comparing multiple, either mutual funds or PMS, what you've got to see is how diversified and how risky those specific portfolios are. And I think our portfolio would be one of the most diversified. At least I don't know of any other PMS that has 100 plus stocks in their portfolios. Okay. Does your diversification mean that you have almost 1 to 1.2% allocation in each stock? So no. Again, the way we allocate capital to each stock is also rule based, and that has helped us generate very good returns. So, based on the overall factors, we get a consolidated score, and based on that, we are actually able to figure out which stock is much more likely to do better than the others, and accordingly, we give weights. So, I don't have that data currently with me, but if I just tell you some of the stocks which have done best is also are also the stocks where we have given the most weightage. So some of those could have 8 to 10% weight as well, right? So that actually helps us creating that alpha. So it's not an equal weighted portfolio. Even the weights that we are giving is very systematically and scientifically allocation of capital to each stock. That's what we do. Last question, what is the difference between Gullak Gear 6, which is a portfolio, our portfolio on small case versus Long Alpha? Now, Gullak Gear 6 is meant for investors who are typically investing much smaller amount of money, maybe about few lakhs only, whereas PMS is for people who are investing 50 lakhs plus. So PMS is much more diversified in nature, whereas Gullak Gear 6 is, because it's a portfolio we wanted to offer to retail investors with much smaller capital, it's a more concentrated portfolio. In terms of the historical returns, Long Alpha PMS, because it is more diversified, obviously the returns are lower than Gulla Gear 6, but the order of difference is just about 2 to 3% only. So that's the order of returns difference that we expect in Gulla Gear 6 versus PMS. And it's more diversified. I think the execution is also uh, one big edge in Long Alpha PMS because we have very low latency infrastructure. We are a broker ourselves and we charge zero brokerages. So our execution is very efficient. So some of you who might be investors in Gulla Gear 6, and if you have more than say 5 lakhs capital, you must be encountering a lot of slippages during every month. Whereas in Long Alpha, what happens is because we are executing on our own using our high frequency execution algorithms that we have developed specifically for rebalancing, our slippages tend to be very much in control. So that is one big edge. And I think I've already told you we charge zero brokerage on these trades which are being done during the rebalance every month, right? So those are the differences. Now, I'll quickly take the questions that some of you have shared. So Shriram has shared, owners of mutual fund don't need to book LTCG losses and gains when in PMS like yours, we need to pay STCG. Yes, you are correct, Shriram. Do you have a view of the current return? So your first part of the questions regarding taxation, you're very much correct regarding the taxation, but but even if you see, because what we have shown is we have delivered double the returns of BSE 500. So even if you take those STCG into account, our returns are still substantially higher. So again, I do not have the numbers, but if you get in touch with us, we'll be happy to share the exact calculations of how much you would have paid actually in the short-term capital gains tax. And even after that, you are actually, there's a good amount of difference between our returns and the index returns, right? Do you have a view of the returns of Gulla Gear 6 versus tax sister returns? I don't know tax system returns, but as I've already told you, our long-term view, as per the backtest, what we expect is about 2 to 3% return differential between Gulla Gear 6 and our PMS, right? Okay. Next, is there any option of automatic rebalancing without needing to click every month? Yeah. So in Gullak, obviously, no, because and it can't be done because of the regulatory reasons. But in PMS, obviously, what the way it happens is we will pool in all the investors' money at the end of the month. We rebalance your portfolios using our execution algorithms, and then uh, each and every investor is going to be allocated those trades at exactly the same price. So we have a lot of Estee's family, our employees and our employees' family and friends have also invested, and they are outside investors also. So the good thing about this methodology is each and every investor, whether that is an internal or external investor, gets those trades executed at exactly the same price. So the kind of returns that uh, each and every investor is getting is exactly the same, right? Naveen has asked, sir, please tell me regarding your journey, how from IIT to STPMS you have reached. So, Naveenji, what I have, uh, I'm an engineer by education from IIT Kharagpur, but I've always been interested in stock market. So even during my college days, I and a couple of my friends used to create portfolios on money control, and we used to track our performance. Obviously, at that time, we didn't knew too much about trading. But after my graduation, I got a chance to work in this company called Futures First, where I was trading international markets, and I was with them for 10 years, and I headed their crude oil desk. But after that, I thought I wanted to shift my focus to Indian markets, and roughly around 10 years back is the time when I shifted from international markets to Indian markets, and also from discretionary style of trading to purely systematic and quant based trading and investing. So in brief, that's what my journey has been. Are you using AI? That's what Hartej has asked. So Hartej, we are actually in experimentation stage. Currently, we are not using AI in our production models, but we are using a lot of ideas as to how we can effectively use AI. And maybe in the near future, those models would be incorporated in the actual stock selection. But as of now, we are not using it. But yeah, we do have a lot of very good talent, and we are using in terms of experimenting these models. But as of now, we are not using. Do Sambhav has asked, do I get returns if I invest in iAlpha during the middle of the month? So Sambhav, unfortunately in iAlpha, because the way these trades are done and the way these trades are matured at the end of the month, we do not allow investment during the month. So the incoming money also goes in at the start of the month, and whatever is exiting, that money is also coming out at the start of the month. And middle of month, no redemptions are allowed, and not even the new money goes in, just because of the way I explained the trading is happening in IRFA. Okay. Now, Santosh is asking, one of the biggest concerns I have is the higher taxation due to churn. Being in the highest tax bracket, what is the tax adjusted returns? So, Santosh, what I'll request you to do is if you can get in touch with our team, and in fact, we will get in touch with you and we'll explain you with the data how much of, even after paying those higher taxes in STCG, what's the difference we have been able to create, and that is substantial, right? So we'll be happy, we'll be connecting you. I think we have your when you registered, we'll have your phone number and email ID, and our team will get in touch with you and explain you. But the difference is pretty substantial, even after paying those taxes. Okay. How are the gains from iAlpha fund tax? So iAlpha, what happens is the overall profits are has two components. One is the interest. So what we'll do is you give us 100 rupees, we'll put those 100 rupees in FD. So we'll get the FD returns, and using that FD as collateral, we'll get some margin and we'll do these arbitrage trades. So roughly out of those 12 to 13% returns, what's happening is roughly 7% returns are using FD. So that is being taxed as FD. And Rest of the returns are coming through FNO strategy. So rest of the returns, roughly 40% of the returns would be coming under your FNO income, which is being taxed as per your income tax slab, right? And even FDs are being taxed. If you invest in personal capacity, then they are being taxed as per your income tax slab. So taxation wise, I think they're as good as FD only. But FD versus I alpha after fees, what you can expect is about 2.5 to 3% additional uh, income, 2.5 to 3% as compared to FD, and the fact being it's a monthly liquidity product. Okay. Shriram has again, thanks for answering my question on STCG. I'll be thrilled to get your analysis of returns adjusted for STCG and some leading mutual fund and indexes. Also, there is a compounding game by not paying out to the government in taxes. Yes, the tax compounds. Yes, exactly. There is mutual funds are great, and in PMS we do not have that advantage. But at the same time, the returns that we have been able to produce, and we'll be happy to share that the returns we have been able to produce are substantial in nature, and even after paying those taxes, you will actually be ahead of at least the index and most of these mutual funds as well. On the FD income, will there be TDS? Yes. On the FD income, there is a component. There will be TDS. Yes. Santosh Patel, you spoke about the option of having a SIP from alpha to long alpha. Is there an option to also transfer when and if markets correct? Santosh, yes, the option is always there. Uh, at the end of the month, that option will always be there for you if you want to, let's say, if you feel that you want to shift back from long alpha, shift from equities to our alpha product, that option will always be there for you. Only thing is our recommendation, because we feel that nobody can time the markets, it's always good to stay invested in the markets. But that option is there with all the investors. You would have that option. Yes. Okay. So thanks a lot, all of you. I have taken all the questions. If you still have questions, I'll be happy to take. If anyone has any other question, I'll just wait for a moment or two, and then we'll wrap up. Okay, Parin Rabadia raises hand. Now, if you can please, okay, let me try to unmute you once. Yes, Parin, sorry, I did
Hello,
not.
sir. Good evening. I think we met in the Estee meet way back in March.
Okay, I do
I
not
came
remember,
from
but
Gujarat, Jamnagar,
yeah,
Gujarat.
yes. Yeah, please tell me. You have
Yes,
any?
sir. I need to know the expenses, like kind of expense ratio. What kind of expense ratio are we talking about in this PMS Alpha, Long Alpha? I'm
Yeah,
interested in that. Already I'm in Gulak 6 since a
okay.
point of time now.
Yeah. So, in talking about our fees, our standardized fees is slightly on the higher side, but currently, for all the investors who are coming directly to us, what we are offering is our fees in long alpha is less than 1%. So overall, if you choose the fixed fee model, it will come out to be 0.96% of overall AUM. So that's the fees we are currently charging, and this will stay for life. And even if you put in more funds, let's say 1, 2 years down the line, this fees for you is going to remain the same if you join currently, which the fees will be 0.96%. We also have another model in which we charge zero fixed fees, but only on the basis of performance. So you pay us only if we outperform the benchmark. And if you are unable to outperform the benchmark, the fees will be zero. In that, the fees is actually 16%, 16% of overall excess returns that we have produced. So let's say in a year, uh, we have produced 30%, whereas the benchmark has given 20%. So that 10% alpha that we have produced, we are going to charge 16% of that 10%, which will come out to be about 1.6% of overall AUM. So those are the broadly two ways, and one is hybrid of fixed and performance. But those are the three models that we are currently offering to our investors. Okay. Okay. Any other question? Santoshji has written, thanks for the session. One of the nice things about you guys are the informative sessions and the level of transparency I've seen. Thank you, Santoshji, for your kind words. Okay, as always, it was really good to talk to all of you and answer your questions. Thanks a lot for your time. Thank you. Bye bye.